All right, guys, welcome back to the Independent Investor channel. My name is Ryan. This is part of a two-part series that I came out with for new investors that are looking to step into the stock market and they don't know where to start. I chronicled the do's in the stock market, things that you want to address before you start. In this video, I'm going to talk about some of the things that you don't want to do, things that you want to avoid. And this is coming from a lot of experience, 25 years in the stock market. I've kind of fine-tuned what it is that works. So I typically gravitate toward those things that have been proven to work in all market conditions. I think we've been lulled to sleep a little bit, even with the volatility that we've had, in expecting that the stock market is just going to go up all the time. And that is just not the truth. So I really want to talk about some of those things that you need to avoid. And if you've gone through the first video of things to do, this is going to help you understand and focus on those things to do and avoid these things that I contend that you should not do. All right. The first thing that I want to talk about is to don't over lever to the stock market. I see this mistake all the time. People want to save up and they want to take their first $1,000 or their first $5,000 and they want to dump it all in the stock market. Now, those starting amounts are good starting amounts, but do not put yourself out. Don't put yourself in a position where all of your money is tied up in the stock market and you don't have any money to eat or pay bills or pursue different things like college opportunities, self-learning opportunities, things like that. And this is something that is super important. People think that when they start in the stock market, they have to jump in with both feet. And that is not the case. The landscape now allows you to start your investing accounts free of charge. And with the emergence of partial share purchases, you can start with as little as $100 in the market. So it really does give you that freedom and flexibility to start with a lower amount and let yourself evolve as a stock market investor, okay? Don't just dump $5,000 into the market and then struggle to survive day to day, because what's going to happen is that $5,000 is going to drop 10% and you're going to be looking at that and you're going to be saying, man, I could have used that money to live on. And I think it really does give away a lot of control that I insist that people have in controlling your money and not allowing your money to control you. If you're too over-levered to the market, that in essence is what is going to happen. You're going to start anticipating that that money can only do one thing, and that is go up. And that is an unrealistic expectation of the stock market, okay? You cannot be surprised when your invested dollars act like invested dollars, because if you're looking for short-term validation over that $1,000 or $5,000, you're going to justify yourself out of the market because it's going to go up and it's going to go down day to day. And you're not going to be able to look at it one day and say, wow, I'm so happy I'm an investor. And then the next day, be like, wow, I want out of the market. It just doesn't work that way if you're actually investing for the long term. So I would insist that each and every one of you guys tuning into this video talk about the importance of risk mitigation and not over levering to the stock market, okay? It never ever hurts to have a cash buffer on the side and make investing and your invested portfolio just a certain percentage of your total overall net worth and not in its entirety, your entire net worth, okay? Don't over lever to the stock market. You'll be glad you took me up on this, okay? The next thing I'll talk about is don't get emotional, okay? Don't get emotional about the stock market. It's not that big of a deal, okay? I typically do not prescribe to anything other than investing correctly is rather boring. Once you get your program put in place and you've worked really, really hard to establish your plan and your program and you've implemented that plan and program, you don't want to sit there and over monitor the account. Now you can if it doesn't prompt you to act against what the portfolio is telling you. but you don't want to get emotional, man. You do not want to buy into all of the injects that you get from social media now or the news media about what you should or shouldn't do with your money, okay? And there's a lot of people out there that are very, very persuasive about what you need to do with your money. You find the irony in that? The person who should understand the best way to deploy their own capital should be you. It shouldn't be all these other injects around the world. And I think if you're paying too much attention to those injects, I really think you should probably try to find your center again and understand it's okay to monitor the landscape, but that's all it is. You don't have to get emotional about, about what everybody's saying, about where the stock market's going to go, what that should mean for your money. What is good for your money is what you say is good for your money, all right? So try to keep emotion out of your investing capital. Don't be surprised when it goes down, and don't be surprised when it goes up, okay? That is the neutral approach with regard to emotion that you should tack on to your investment strategy going forward, okay? The third thing I will talk about is try not to overthink your investing strategy. Building a portfolio is one of the most fun activities that somebody can do. I love building portfolios. It's super, super fun to build a portfolio for a beginning investor. It's super fun. Depending on what the investor profile is and what the risk tolerance calls for, it's super, super important not to overthink investing. I see this all the time. I have people come to me and they're just like, wow, we've got this small biopharma company that has found the cure for whatever ailment is going through society right now. That's going to be my primary holding in my portfolio because I researched this thing for 3 hours and I've determined that this is the next best thing. You want to avoid the next best thing investing, okay? Sometimes the best investments, if not all the time, are the ones that are right in front of your face. The ones that produce products that you use every day, whether it be Procter & Gamble, whether or not it be Kimberly-Clark, whether or not it be an Apple computer or a Microsoft, whether it be Home Depot, a company that you go to all the time and you never really thought of as a viable investment opportunity. Now you're thinking like an investor, okay? Don't overthink this thing. Don't make it more complicated than it needs to be. Make no mistake about it. The hedge funds are doing what they need to do to try to outperform the market, and that is lovely. Those clients are paying 20% right off the top to allow those hedge funds to take large chunks of capital and try to seek alpha in the stock market. That means nothing for the regular investor like me and you. The regular investor should be looking to participate in these great companies that have strong balance sheets, but more importantly, have staying power. Microsoft is not going anywhere. Home Depot is not going anywhere. These companies that have been established for years and years and years. Johnson & Johnson's been around for over 100 years, right? So we want to make sure that we're looking at our investment opportunities and we're taking part in those companies that have been around for a long time and will be around for a long time. Staying power. Don't overthink investing, okay? It's really not that difficult. Getting your mind right, now that's the difficult part, all right? Another thing you want to avoid is investing like others. This is a big one. Your investing profile should reflect you, all right? Now you say, Ryan, well, I'm starting. How am I supposed to understand what investing profile is good for me? Well, start defensively, all right? If you have very persuasive investors that come onto YouTube and they're very, very charismatic, they're very, very adamant about certain stocks and that emotion doesn't jar with your inner instinct and you're thinking, you know what, that sounds great, but that just really doesn't sound like what I want as an investor. I think a diversified ETF might be a better route for me. It just makes sense for me to give myself a chance to opt into the stock market and buy as much diversification as I can, because I really don't know what I'm looking at just yet in single stock. I'm going to shelf that opportunity. Okay, I acknowledge that there's probably some very, very good money that can be made by investing in single stock, but I want to give myself a fighting chance. I want to rely on the fundamentals of my plan, the opportunity to seek diversification. All of the things that we talked about in the do video are the things that you want to rely on as your solid foundation in your portfolio, right? So when you start to just invest like others and pick up a couple stock picks over here, or you're tuning into a video with somebody that has $500,000 and you don't know where that $500,000 came from, but you're assuming because they have $500,000, they know exactly what they're talking about. That's a red flag. Very, very dangerous for new investors to tune into anybody on social media, not do their own homework, and just jump into a particular recommendation because they've newly become aware of that stock, okay? A lot of people tune into YouTube to get validation on a certain stock, and it's like, okay, since this person is investing in it, it's okay for me to invest in it. You don't want to do that at all. It's okay to tune in from an awareness perspective to gain more of a general awareness about where people are putting their money, where people are seeking exposure. If there's a certain sector that you're unfamiliar with, probably real estate, right, is a good one. If you're not really familiar with that, or you're not really familiar with the material sector, to gain some awareness on those sectors, but not to just rush out and jump in and invest in the stock market like others, okay? It's got to make sense for you, and it's got to be in line with your plan, your investor profile, and your risk tolerance. Very, very important. The next one I say all the time, and this is a don't hope, okay? Don't invest and sit there and cross your fingers and hope that your portfolio somehow does something that you expect it to do. Certainly have fair expectations in the stock market, but hope really doesn't have any place in the stock market, okay? Take it from me. It doesn't matter how much you hope a stock goes up. It's going to do what it is that it is going to do. A stock is going to act like a stock from day to day. It's going to go up or it's going to go down. Okay, that I can guarantee you. But what are you hoping for? All right. Do you have realistic expectations about where your particular company could go? Did you buy it at a 52-week high based on recommendations you got from everybody else? Or did you pick it up on a 52-week low, potentially, when a good name that you were monitoring for quite so many months finally gave you that good disciplined buy point, right? So know that your buy points are working for you, as opposed to just blindly entering into stock and then hoping that that pick goes up. Remember, we're entering into these companies that have been around for decades, and we're expecting that those companies are going to be around for decades going forward, all right? It's super, super important to do away with hope, invest in the stock market, and by investing in that, you take on the inherent, obvious fact that you're taking on some level of risk, that investment from the second you hit buy could potentially lose value. It's okay. Don't be surprised by this, okay? Don't be hopeful that that stock is just going to go up every single day that you own it. It's not going to happen, okay? Take on all the defensive mechanisms that I've recommended that you put into place before entering into the stock market, and then understanding that when you're standing at that 99% mark and you're just ready to fall over the finish line and deploy this plan in the market, that once you deploy that plan, let it go, all right? Go on about your life. Go on about doing what it is that you do best in this life. Don't sit there and stare at your portfolio hoping for it to go somewhere that it may inevitably end up someday anyway, or it may not end up someday. All right, chances are it's probably going to do what it is that you expect it to do from the first day you invest in that stock, but sitting there staring at it every single day is not going to help you. So eliminate hope and start to initiate discipline into your program going forward. The last thing I will say with regard to what not to do in the stock market is to react to every opportunity that comes your way. The stock market is a wonderful wealth generating vehicle. It's wonderful, and there are infinite number of ways to make money. There are also an infinite number of ways to lose money. It's amazing to me how many people out there continually go down the path of very, very risky investments, very, very risky strategies, and they spend a lot of time losing money in the stock market. And those are very dangerous people because they fail to realize the errors of the way. Now, there are no perfect investors out there, but I find it ironic how there's so many people who know exactly what stocks to invest in and what is the next best thing. I would highly anticipate that you avoid, if not completely avoid, all of those temptations as they come. It's okay to observe those opportunities as they come, but you don't have to act on any of them. I think you'd be probably better served if you'd not act on the vast majority, if not all of those opportunities. I typically just give an acknowledgement, and I move on with my life, and my program stays for the most part intact most of the time. Guys, I really hope you enjoyed this video of what not to do in the stock market. It really does go hand in hand with my what to do in the stock market, and I find this will be extremely valuable on how to separate the sea, how to define the gray matter into black and white on what to do and what not to do. If you're new to the channel, please hit the subscribe button for us. Leave your comments at the bottom of the video, and you want to share this video with anybody out there that's looking to enter into the stock market. We want to make sure that they're given a fighting chance, okay? You can hear it from me. I'm investing most of my life, and these are things that I deploy in my personal playbook. Honestly, I've probably missed some of the do's and some of the don'ts, but these are some of the most important ones that I thought were worthy of discussion and pushing out to you guys. Guys, thank you so much for tuning into the video, and good luck in your investment future.